Our monthly real estate national trends update. I'm Nick with Ironton Capital. I'm joined here by our CEO, founder of both Ironton Capital and Your Castle. Lon, how you doing?
Great. How are you guys?
Doing good. I'm also joined here by Joe Massey with Castle and Cook Mortgage. Joe, what's going on?
Thanks so much for having me, guys. Always appreciate the invite. Excited to talk about some new slides we've got today. So appreciate you guys making the time for me.
Awesome. Yeah, we got a lot of great updates, everybody. There's a chat box on the right-hand side. So as we're going through the information, don't be shy. Feel free to send over your questions or comments, and we will work to address them as we go through the presentation. So with that being said, Lon, I'll turn it over to you.
Sounds great. Well, thanks everybody for taking time on your evening away from your family to be with us. You want to know how to analyze whether real estate prices are going to drop or go up, what's going to happen to the fluctuating in mortgage rates and what kind of impact that'll have on your market. You want to forecast the future pricing trends in the apartment market. So, having a deep understanding of all these different trends is what allows really good investors to make consistent profits no matter what is going on in the market. And that's why we're here today. And as you have questions, type them into the chat box as we go, and we'll try to incorporate all those as we go. What I often find is a lot of people try to make decisions based on what they see on CNBC or what they hear in a coffee shop. And our goal is to be able to give you a more factual basis so you can really dive into what's going on. So we're going to give you the key indicators to understand whether it's time to buy or sell and have hard data to make decisions. So the case studies today, I hope, are going to illustrate what is possible in real estate. It's not an income claim. Actually, it leads up to this little love letter from our attorney. None of what we're talking about today is an offer to invest with us. We're actually not going to go through any of our funds. We're just going to share what's going on in the real estate market. There's going to be a lot of forward-looking statements about what we think the market's going to do next: plan, will, should, expect, seek. Joe's even going to tell us what will happen with mortgage interest rates, which I'm amazed that he's got that kind of a crystal ball. Just make sure you review all this with your financial advisor team before you make any investment decisions based on them. So let's take a look at the main summary points. So if you're just trying to have a couple of coaching points for your clients, prices are up a little bit in 2023. Overall for the US, they're up a little bit in 24. The pace of the appreciation is slowing down a little bit. And I think that's more because the buyers are slowing down than anything else. We are seeing, to my surprise, more sellers, even in this higher rate environment, saying now is the time to sell. And I think a lot of that is there's only so long you can put off some family events that tend to drive this. I heard a really humorous story about a couple that got divorced. Neither one of them could afford to buy a house on their own at the current mortgage rate. So the husband moved downstairs, the wife is upstairs. And you can just about imagine the level of tension in that household. So as we see more inventory coming on the market today, I mean, that's not the only cause, but there's a lot of things that are like that. At least in the Denver market, we're seeing for the first time in quite a while that some neighborhoods are actually becoming a buyer's market, which is something we haven't seen in a number of years. So just like really briefly, Joe, can you tell a little bit about what's happened to rates since a month ago?
Yeah, since a month ago, we've seen rates improve, between 1/4 to 3/8 of a point, depending on which days you compare. But I really like what you put on here. Rates have improved from 8%, which is where we peaked out in October of last year or November. We're down to 6.5% as of today. But affordability does still remain the primary challenge. And it's not only interest rates. I'm going to touch on this a few times. Homeowners insurance is up, taxes are up, and HOA dues are up. So the cost of owning a home is more expensive in a lot of different metrics. And we'll touch on this more in the future, but rates are likely to improve another 1/4 to 1/2% over the next 90 to 180 days. We'll talk about that in more detail as we get into the presentation.
Excellent. So what's going to happen for the rest of this year and for the very first part of 25? I think prices are going to be generally flat in most markets to maybe very, very small amounts of appreciation. I think you're going to see the volume, which this year has been sort of disappointing relative to last year, is going to continue that trend. I wouldn't expect a huge uptick even as the Fed starts to cut rates, which I do think they will cut rates. What do you think, Joe, 2-3 times this year?
I agree. Yeah, I do think they will a couple times.
So it'll have a little bit of a favorable effect on rates, but not a ton. But you won't see the psychological impact of that probably until spring of next year. Homeowners who are ready to move now are in a solid position. Like, you've got a good time to be able to negotiate right now. It's my guess, and it's just a guess, is that we're probably about in the 7th inning of this downturn. I think that you're going to see things really start to turn around probably in February, March of next year. So for the buyers who can buy now with the rates being a little high, the flexibility of maybe doing a refinance, what do you think, Joe, 18 months from now?
I would agree 100%. I talk to buyers all day, every day, and I really like what you have on here. The number of buyers is going to grow faster than the number of sellers when interest rates go down. By today, we have our free refinance voucher that you can refinance at any point in the future whenever interest rates go down, but you'll be able to own that property today and take advantage of increasing prices between now and March. So I think you're spot on, Lon.
Yeah, definitely take advantage of it. So looking on the right-hand side, if you're a first-time buyer, I'd buy now. When the rates drop, when we get past the holidays, when we get past the election, I've got these 3 hurdles that I've got to clear. Then I think you're going to see an uptick in volume. And volume next year is going to be a lot better than it was this year. And it's probably going to be a lot better than it was in 23. I mean, nothing like 22, but it'll be a really solid year next year. So once that, some neighborhoods that are really desirable is going to be back to maybe a little less than a free-for-all, but maybe difficult to get showings. You may not be able to get an appraisal on your contract. You may not have a whole lot of negotiation power on the price or on the inspection. Right now, the buyers have a lot more advantage. I would really want to take advantage of that if you could. Trade-ups, I would say it's the same thing, but your home has got to be parade ready. The number of buyers looking right now is down from what we'd historically expect. So the really great houses that are set to go without a lot of deferred maintenance that are priced correctly are still selling. Nothing else is. If you want to sell and you're not buying, I would wait till spring. It's going to be a much more favorable market for you in March than it is right now. If you're a trade-up buyer and your house doesn't show well, this is probably not the time for you. It's going to be extremely frustrating trying to sell your house in this market environment. And if you're an investor and if you can find something, I'd go ahead and pounce on it and then do the refinance as the rates drop. All right, elections in real estate. I know that, Joe, you've got some thoughts on this too. So
Yeah.
As we go, actually, you want to kind of give some highlights on this?
Yeah, so I would really start with this headline. The elections don't have a long-term impact on home sales. It mostly slows down sales counts in November, but those delayed sales are recovered really by January, February, or March of the following year. And I think the next slide really shows that that you will see on the left-hand side there, in non-presidential election years, there's a seasonal slowdown that in November, sales are down 9, almost 10% as compared to the month before. But in a presidential election year, those sales in November slow down 15% as compared to the month before in October. So you see this really big seasonal slowdown that gets exacerbated in an election year. But look over on the right-hand side, what happens the year after? In 9 out of the last 11 presidential election cycles, sales volume increases the following year. And frankly, I don't think that has anything to do with the election. I think it has to do with just the fact that things generally are improving from one year to the next, most of the time, not all the time. But that slowdown that we're going to see from now over the next 90 days is all going to be repicked up in the 90 to 180 days following the election. What do you think, Lon?
It's all that. I think the easy way to explain this to someone is that the number of sales is like the amount of air in a balloon. And you can think about, this part of the balloon is November. We're going to squeeze that. We're not going to have as many sales in October, November. It just pushes out the balloon in December, January, February. But the total number of sales is going to be exactly the same. We're just going to postpone them a little bit.
That's right.
Guys, would you attribute that to people just, as they approach the election season, there's uncertainty. People are just waiting to see what happens. Okay, gotcha.
Yeah, that's what it is. I've been through this like my 6th election cycle in real estate, and every single time it's a presidential election, it's the same. People wringing their hands, and I want to wait and see. Like, well, is it going to make any difference to you? You're still,
yeah,
you're still in a middle school that you don't like, and you want a better teachers. Like, nothing's going to change because of the election with that.
Yep.
Or the fact that you just have another kid and you really need another bedroom. So the price trends, between 2008 and 2009, we saw prices drop. That was because of a larger recession centered around foreclosure problems. Every other year, we've seen the existing home prices have gone up after the election. For new homes, the exact same thing, 2008 to 2009. Again, they declined because of the overall recession, not because of anything related to the election year. So if you've got people who are curious about what kind of impact does the election have, you are now armed with a lot of really good facts to be able to resolve that. And then, Joe, what about rates?
Yeah, so I love this chart. Mortgage rates have decreased leading up to 8 of the last 11 presidential elections, and we're experiencing that again this time. So I'm going to post a link in the chat. I actually did about a full 15-minute analysis on what happens with interest rates in the 90 days leading up to the election, the 90 days after the election, and that full 180-day election cycle. And the conclusion is 77% of the time, interest rates decline over that 180-day cycle, and they go down about 0.5%. 23% of the time, interest rates go up over that 180-day cycle, but they increase about 1.5% in interest rate. So there's, a 77% chance based on historical analysis that interest rates are going to decline over the next 180 days. However, in that 23% of the chance, 23% of the time, interest rates go up by 3 times as much as what they might go down by. So a way to counteract that is buy today and refinance in 6 months or 18 months or 24 months whenever interest rates go down by a significant difference, or just understand that there's no direct correlation because there's so many other factors at play in interest rates rather than just the presidential election. So I'll put that link in the chat if you guys would like to watch. It's a little long for the scope of what we're doing today, but maybe go and watch that after our presentation today.
Probably everybody on this call has got 2 or 3 prospective clients that are just really obsessed with the election, and they'll be great candidates to want to watch the entire thing.
Yep.
So I'm going to skip through this part because we've got a lot of investors on the call today that won't find that too useful. I do want to talk about confidence. So if you ask consumers, do you think home prices are going to drop over the next 12 months? There was a lot of dialogue in the media in late 22 about a repeat of the 2008 crash, which was completely unwarranted. And we saw that a large number of people, about a third of Americans, thought prices were going to go down. That was sort of a dampening effect on people wanting to buy a house. And that has since been pretty much cut in half, which is great. So we're making good progress there. However, while they're more confident about prices being stable, that doesn't mean that they necessarily want to buy right now. And high mortgage rates are probably the largest deterrent. And then insurance and taxes are not helping any at all. So in May, 14% of consumers thought it was a good time to buy a house. The number of people thought it was a bad time is about 86%. So this pessimism that we've got here needs to improve a little bit before we really start to see the buyer volume start to take off. And that's why I don't think it's going to be this year. I think it's going to be first quarter of next year. It's partially the election. It's hard to feel positive about anything when all you see nonstop is negative ads on TV about the world's going to come to an end unless you vote for me. We've got to get that out of people's minds. That means get the election, wait 30 days, it starts to dissipate, and then optimism will come back. Do you want to talk a little about net worth, Joe? And is real estate still exciting to buy?
Yeah, this is one of my favorite slides. We talk a lot about people worrying about, hey, it's a bad time to buy real estate. I want to wait. I want to see what's going to happen. And we had a lot of those exact same sentiments back in 2010. So on the left-hand side of this chart, let's say you were a tenant in 2010. That's the bottom green line there. That's the average net worth of a renter was $5,400. And if that person said, you know what, I'm going to wait because it's a bad time to buy, and they waited all the way until 2022, their net worth nearly doubled, went from $5,400 to $10,400. But the person that bought a property on the left-hand side, represented by that blue line, had a net worth of $187,000, bought a property or owned a property at the time, held on to it, and now their net worth has also doubled. But doubling of $187,000 now equates to $396,000. So the person that owned a property and held it for the last 12 years gained $385,000 more in wealth than the person who decided to rent. And so if you were to extrapolate this out and wait another 12 years, maybe that renter is now going to have an average net worth of $20,800. But that homeowner is going to have an average net worth of over $800,000 or nearly $800,000. So I think this is a really important point to remember, that time in market is more important than time of market. Saying that it's a bad time to buy a house and I don't want to buy right now, that's okay. I understand that for your personal situation, but you may be leaving a lot of money on the table and somebody is going to gain that equity. The only question to the investor or to the buyer, is that going to be you or is it going to be someone else?
Love it. That's fantastic. So if you ask Americans, what do you think the best long-term investment is? Real estate is still the dominant choice, quite a lot higher than the stock market. And given the volatility in the stock market recently, that's probably not a particular surprise. I'm always amazed that gold ranks as highly as it does, being a non-interest bearing sort of an asset.
I'd like to point out on that, Lon, I'm actually now in the 3% of people that think that cryptocurrency is the best long-term investment. No, I'm just kidding.
I know a couple of guys who invested in crypto have done really well. They got the timing right, and there's always a couple of guys that are like that, and good for them.
That's right.
All right, our price is going to drop. I'll be really quick on this. Most people now don't think that's going to be an issue. Prices have stopped going up. You can see in late 23, we had 2 or 3 months where prices on the average in the nation did go down a little bit, but it's since reversed since then. So what I want to look at, though, is the long-term trend. This kind of gets to what Joe was talking about from a wealth building standpoint a few minutes ago. This is the average price in America from 1991 to current. So the national average is that the average real estate condo or house tripled in value. The 3 leaders are Utah, Montana, and Colorado. But even the 3 laggards, Illinois by a long shot, New York, and California did pretty well. Just not quite as well. So inventory is growing across the entire country. So for those of you in the Colorado market, we're up about 40% year over year. That's relatively consistent across most markets in the U.S. I'm not exactly sure why Nevada decided to drop 25%. There's probably population growth there is probably what's driving that based on, I was just actually in Nevada looking at a bunch of rental properties that are under construction. So if you ask all these different experts at these 7 different economic groups, their consensus for appreciation this year is going to be 2.8% across the entire U.S. I think that's probably pretty close. And their consensus for next year, which is not illustrated here, is 2.7. That's probably about right. That might even, it might be a little bit higher than that. We'll see. It'll vary a little bit depending on the market. If we see the number of buyers increase a lot faster than the number of sellers, and if we do see a meaningful decline in rates over and above what we're talking about, then the appreciation will be higher because there'll be too many people chasing not enough listings. I don't think the rates are going to drop that much. I don't think we're going to get in that supply demand imbalance. I think this 3% is probably just about right.
I agree.
Joe, can you explain debt to income? What does that mean to you as a lender?
Yeah, so debt to income is how much money are you spending out of your monthly budget to pay for your debts. And the black line there in the middle is 25%. And that's what's considered kind of a healthy number. That if you bring home or you make $10,000 a month, you're not spending anything more than $2,500 on your monthly debts. And you see the blue line is where we've been all the way back since 2000. And we've historically been below that 25% cutoff. Now, it's not that you can't get approved above 25%, but this is an average of all homes in the United States. And we are seeing that now we're at the highest we've been in the past 24 years at an average debt to income of 27%. So that means affordability is a challenge. More people are having to spend more of their budget to afford a home right now. And that makes it a little tougher for buyers, which leads to not as many buyers chasing more listings, or as we're seeing, more inventory. So back to that very first slide we looked at, if you're a seller, these folks that are buying are having challenges affording homes. You want to make sure your home is absolutely parade ready. And if you're a buyer, you want to make sure you're looking at stuff that's in an appropriate price range for you and you're not overbuying or paying too much for a property, because it is a little more difficult now as compared to any time in the past 25 years.
Yeah, absolutely. That's a great explanation for this.
Joe, can we go back to that slide real quick? You know, most first-time home buyers are likely not putting 20% down. They're in the 3 to 5% range. So what does this 27.3% number increase to for somebody that's a first-time home buyer and is putting 5% down? Are we above 30%?
Yeah, you're probably close to 35, maybe even approaching 40%. Now it's hard to say, right? Because that's what I see on an anecdotal level for first-time buyers. I don't have, stats of first-time buyers to the entire nation. But certainly first-time buyers spend a much higher percentage of their income on their home because they're buying that first home. They don't have a big down payment. They probably have not reached their peak earning years yet. They're really just getting their foot in the door. And we all remember buying that first home and being young and like, hey, I'm going to buy the house and I love it, but I got to fix everything myself. I'm buying a used washer and dryer. I'm eating ramen for the first 3 years that I live in my home. But then when I trade up, I have a big down payment. I'm making more money at work now. My debt to income becomes easier. But I think you're exactly right, Nick. Those first time buyers, they're included in the averages here, but they're certainly skewed higher than that 27%.
Yeah, that would really be normal. All right, so problem that we've had in the U.S. that's driving a lot of this is that the price has gone up faster for homes than the household income, and that's what you see on this chart. What's interesting is that this is not unique to America. It's actually happening in most developing countries. So if you take a look at this chart, you can see in Canada, home prices have accelerated quite a lot faster than income, and the gap is much larger. I'll go back to the US for a second just so you can see, like, there's a gap in America, but it's not like that dramatic by comparison. If you look at Australia, France, and the UK, as frustrating it is to be a first-time buyer here, it could be a lot worse. You could be in these other countries. And Joe, I don't know, you may not know this or not, but I think most of these countries, they don't lock the rate for 30 years, right? They just lock it for a much shorter period than it floats, so it's harder to qualify.
That's right. A 30-year fixed interest rate is very unique to the United States. Most of these countries you're looking at here, actually all four of the countries you're looking at here, they all have fixed terms of 5, maybe 7 years. And then after that, it is a variable interest rate. And one question, Lon, that maybe we'll want to talk about offline, I would really be interested to see the percentage in each of these countries of home ownership versus renters, right? What's the population? Because I would wonder in Australia, with home prices so high, does that lead to a much lower percentage of home ownership and a higher percentage of renters? So I don't know if that's a stat that would be easy to pull, but maybe to add for next month.
I'll see if I can find that. That's a really, really good question. I know in Germany that the percentage of people that own is a lot less than it is in America, which astonishes me for like such a, otherwise I think it's a pretty fantastic economy.
Yeah, pretty civilized. Yeah.
So inventory is building. That's been the headline topic here. So I want to put this in a little bit of context. So if you take a look at just after COVID really got rolling in 21, if we look at 21, 22, 23, our current inventory levels look really high, almost double what we had in 21. But if you take a look at the years prior to COVID, our inventory levels are still on the low side. So I don't want people to be concerned about the buildup in inventory. It's within the normal parameters. It's just that the buyers have been slower, mostly due to the insurance, tax, and then interest rate increases. So some of those things will get some relief on hopefully next year. So
we have a question.
Yeah.
Man, what happens if Democratic policy wants to build 3 million homes? I don't see how this is possible without any more of this change to the residential market.
I haven't yet seen a really detailed blueprint in the New York Times or the Wall Street Journal explaining how they plan to do that. So it sounds like something kind of aspirational, and it certainly that's going to resonate with a lot of people in America. Say, God, that sounds great. But a lot of times the politicians have got a lot of rhetoric without like a detailed blueprint behind it. Let's say that you had 3 million new homes and they each required like $100,000 subsidy. What would that be, like $300 billion of subsidy? I don't know, what's the deficit going to be this year, like $500 billion? So you'd be increasing the size of the deficit by 60% to pull this off. I don't know, you'd have to get Congress to play along with that.
Yeah, I think we don't have the chart in here, but one of the challenges that we've had over the last 15 years since the Great Recession is we have been underbuilding. And we have 4.7 million homes that didn't get built to stay up with our average home building over the past 40 years. So if we were to build 3 million homes in a year, we would absorb all of those within 18 months. So I'm not personally concerned about it. First off, I think that is a very difficult challenge to build 3 billion additional homes in a year. There's a lot of things that are going to prevent that. But number two, even if it did happen, all of those homes would be gobbled up by the buyers that are out there in a fraction or in a matter of months. So I'm not concerned, A, of that coming true, or B, if it does come true, it's not going to impact prices.
Yeah, probably a more realistic approach, just because there's not enough laborers to build the homes, is that maybe you'd build an extra 300,000 a year for a decade.
Yeah.
So the resale market in America is like 5.5 million houses. And I think the new homes are somewhere around 1.5. Let's call it 6.5 million in total. So if you were to add an extra 300,000, you'd be increasing the sales count by 5%. So like Joe said, you would barely even notice. And all the homes that would be built would be very, very entry level. There wouldn't be anything at the midpoint or above. I wouldn't think there'd be any reason to do that. So from a supply standpoint, this is the growth in the inventory of homes available relative to the population change from 95 to 2020, so over a 25-year period. And you can see that Poland was able to keep up. They were working from a deficit of not having enough housing available when the Iron Curtain fell, so they had to overbuild homes for a period of time just to get housing for the people who needed it, as opposed to, say, Sweden or New Zealand, which is a lot more like us, where they built exactly at the population rate, but no more, no less than that. And we undershot our population rate by a little bit. So as a result, the percentage of renters has increased over the last 25 years in America, not declined. All right, is there going to be a foreclosure boom in 07? I'll just gloss over this because I don't get a lot of questions on this anymore. But Joe, just briefly, lending standards, if I want to get a mortgage now, like how tough is it?
It's historically very difficult. So the left-hand side of this green line, back in 2005, 2006, we would give loans to anybody. Lon's dog took out like 4 loans from me, and we were happy to give it to the dog. Now we require paycheck stubs, tax returns, your social security number, do you have a job? Do you have bank statements? So it is very conservative right now. But what that means is that everybody that goes through that process and qualifies for a loan can actually make the payments. So when lending standards are conservative, you see really, really low delinquencies, which leads to really, really low foreclosures, which I think we have on the next slide. And when you see really low foreclosures, oh, there you go. There's the delinquencies. Delinquencies are now at the lowest level that they've been since 1982.
Yeah.
That's not going to lead to a marked increase
40
of
years.
inventory, which is not going to lead to decreasing prices. Yeah, so the lowest in the last 40 years. That means everybody's paying their bills.
Yeah. And historically, isn't that what you tend to see, is that they'll get behind on their credit cards, they'll get behind on their student loans, eventually they'll even get behind on their car, but people don't get behind on their house until everything has really gone terribly.
That's exactly right.
And they'll refinance with you first out of their 3% rate to a 7% rate to get cash out, to buy themselves another couple of years of rope before they'll.
I spoke to someone today who has a 3.25% mortgage rate and $200,000 of credit card debt and needs to consolidate that into a brand new 6.5% fixed interest rate. And it's going to save them $1,400 a month.
There's no way you could possibly ask this, but just over a cocktail, I want to ask, like, what are the top 5 things you got for $250,000 on your credit card? Was it all just go to Target?
Yeah, I think a lot of Target, a lot of Starbucks.
Amazon.
You know what I'm seeing a lot of groceries that people can't keep up with inflation, and they're financing their day-to-day living.
Yeah, that's not sustainable for too long. Randy, I see your question here. Did I miss something on the previous file? Didn't show a great change in recent months. Let me see if I can try to figure out what it is you're asking about here. Maybe was it this slide, Randy, 46? It's been pretty consistent really since 2010, I'd say.
Yep.
It started to get a little easier right before COVID, then it tightened up right again when people got conservative after the panic with the COVID first coming out. If I didn't answer your question, let me know which slide, and I'll try to address your question. So the other reason why foreclosures are really low is that people are sitting on a lot of equity. So this chart on the left from the Wall Street Journal, one of my favorite charts of all time, collectively, the equity in all the homes in America is a little over $30 trillion. The amount of debt collectively is about 12 trillion. So almost 40% of people own their house without any debt.
Mm-hmm.
Amazed that they didn't even bother to take out a loan at 3% and then go invest it. But they didn't. So there's another third of people who have got a mortgage that's less than half the value of the home, and only 28% are actually like at a mortgage that's more than 50% of their equity. So I don't expect any change in the foreclosure situation anytime soon.
I agree.
So Joe, finally, the moment we've been waiting for. Are rates going to go up or down? So what's going on with the rates currently?
Yeah. So, interest rates have gone down over the past, 3, 4, 5 weeks. And this headline, I love it. Mortgage rates are the lowest since February of 2024. But you know what? February of 2024, mortgage rates were pretty high. So we are seeing rates improve. As I said earlier, 6.5% as of today, which is historically over the last 40 years, pretty good. But over the last 3-year recent history, still kind of bad. And that's putting a cramp on affordability. I do expect we're going to see interest rates improve an eighth, a quarter, maybe 0.5% between now and 180 days from now. I do think there's going to be opportunities for folks that bought at 7, 8% interest rates to refinance in the coming 180 to 365 days. We're not quite there that we're going to see a big refi boom just yet. But if interest rates get to, 5.9, 6.1, I do think there will be opportunities for a lot of folks to save money. And that'll make it a little bit easier for buyers to swallow. Hey, I've got a home at a 3% interest rate. If I sell it and I have to go to an 8% interest rate, I don't really want to trade up. But if I've got a 3% interest rate and I can go to a 5.9 or 6% interest rate, that might be a close enough delta that it's worth it for me to get that new kitchen, that nicer school district, that bigger yard. So I think we're seeing interest rates improve, likely going to continue to see rates improve, and that is going to help release some of those golden handcuffs that we're seeing of that lock-in effect that buyers don't want to trade up unless they absolutely have to.
Yeah, I think that's definitely what you're saying there, Joe. No doubt about that. All right, go over the slide here. So one of the things that longer term could help us out is that the mortgage rate really has two components to it. So on the left-hand side of this, you're going to see the 10-year bond. So the federal government is running a large deficit, has for a while, a little bit bigger of a deficit now than it has been historically. They can finance that in a number of different ways. One of them is a 10-year bond, and that's the most common way they like to raise cash. And it's one of the investors' favorites globally. So very, very liquid, especially the definition of liquid. So currently, probably a little bit less than 4%, Joe, like what, 3.8 if I had an updated version of this?
I can look real quick. I think it's 3.8 today.
Yeah.
3.8 today.
So if you want to know what the mortgage rate is, it's the 10-year treasury, and then there's a risk premium that's put on top of that because obviously a mortgage isn't as bulletproof as, something that's guaranteed by the U.S. government. So that risk premium is what, about 2% right now?
Probably 2.5.
Yeah. So historically, that risk premium is closer to what, 1.5, right? So it's about a point higher than normal. So if we were at the market's perception of the normal level of risk in the mortgage credit markets, the risk premium would be about 1.5 right now, not 2.5. And if that was the case, we'd take the 10-year at 3.8, add 1.5, and we'd end up with what, 5.25, 5.5, somewhere in that range.
5.5. Yep.
So the mortgage rates are about a point higher than historically you'd predict because the mortgage bond buyers perceive things to be a little more risky now than the historical average. And Joe, why is that?
Yeah, so I read a really interesting article because we've talked about foreclosures, we've talked about prices going down. And we've talked about tight lending standards. There's very little actual risk that a mortgage holder or a mortgage borrower is going to default. Right. The biggest risk is refinance risk. When rates begin to go down, there's going to be a drove of people refinancing, which is going to be very exciting for me. But when that happens, people that took out loans and these bondholders, they're wanting to be paid back over a 30-year period. All of a sudden, when that loan pays off in 12 months or 24 months, they're not going to make as much money. So the risk to the bondholders is early payoff. And how do they make that up? By charging a little bit more, charging a little bit higher interest rate, so they make more interest and more money in a shorter period of time. So that's the biggest risk to the bondholders. It's not default, it's early payoff, which I think is actually probably a reasonable concern for those bondholders right now, because we are eventually going to see interest rates decrease. And a lot of those mortgages that were taken out over the last 24 months are going to be wiped out, paid off, and moved down to a 5%, 6% interest rate. So that's the biggest. When we talk about risk spread, it's not necessarily risk of default. In this case, it's risk of early prepayment.
So as the mortgage rates, I mean, they've gone from 8 to 6.5. So the refinance risk for a mortgage originated today, I would think would be a lot less refinance risk than a guy who has his mortgage at 8. If it can get down to, like, say, from 6.5 to 6, would the perception be it's even a little bit less of a risk of a refinance, and then maybe that helps to reduce that risk spread maybe just a little further?
Absolutely. Yeah. As rates go down, we'll see that risk spread decline as well. I don't know if it's going to be a dollar for dollar or percentage for percentage decline, but we will see that, because the risk of a 3% mortgage refinancing is very, very low, whereas the risk of an 8% mortgage refinancing is very high. 6% is somewhere in the middle, right? So as rates go down, that risk premium for a refinance or early payoff will go down as well. So I think we're going to see some positive movements on this indicator in the future.
So I want to be really clear. I think there's a 0% chance of us seeing rates in the 3s or 4s again in my lifetime. I think that you could get the high 5s. Probably not much better than that, though, right, Joe?
I completely agree. We're not going to see rates 2, 3, 4% again. Not likely in my lifetime. Certainly not during my career.
Yeah. So for your buyers who may have this psychology, I'm going to wait till rates drop, you might want to try to calibrate what their expectations are to see if they're realistic. If it's, I want to wait for rates to drop from 8 to 6.5 to 6.25, that's doable. That's probably going to happen in the next 6 months. If it's going from 8 to 6.5 to 5, I just don't think that's probably going to be very realistic. So you might have to do some education, and someone like Joe can, get on a conference call with you and your client and maybe just kind of walk through the logic of how the bond market works, if that would be the right stream of persuasion for your client. I just hate to see people miss out. I think this is a really good time to be a buyer, and I hate to have people miss out on it because they're just misaligned on their expectations.
I completely agree.
So for those of you guys who work with commercial, I've got some recent commercial rate ranges for retail, office, and multifamily, and then industrials here. So you guys can download this presentation afterwards. So that way you're not trying to take screenshots of the slide, but that gives you all of the data on that. So currently at 6.5%, historically speaking, how attractive is that rate, Joe?
Yeah, I mean, that's a full 1.25% better than the 50-year average. The problem, though, is looking at the 2000s and 2010s, 6.5% is higher than we've had in the last 20 years. And a lot of folks that are in their peak home buying years don't remember the 1980s. They maybe weren't even born, right? They probably don't remember the 1990s, or if they do, they were in grade school. So the perception of a lot of home buyers right now is, boy, I really remember for the last 10 years that rates were at 4%. Now they're at 6.5%. That's really, really high. And we can look at this chart and say, yeah, but historically it's not really high. But in their recent memory or their adult memory, that is really high. And that takes time for people to adjust to that and adjust their expectations. There's a lot of people hoping rates are going to go back to 4%. And I really like what you said a couple slides ago, Lon. That's not going to happen. We really need to help educate and adjust their expectations.
Yeah, and if you guys need a soundbite for that, I'll just try to explain. And Joe, please help me out, as I probably won't do nearly as good a job as you would. Is the reason why the rates went to the 3s and the very high 2s was that there was a panic of liquidity when COVID. The scope was very large in the mind of the media, and it wasn't really known how bad is this really going to be. And not having liquidity to market is a good way to get into a lot of trouble. So the Fed flooded the market with cash. We gave trillions of dollars of just cash payments out to consumers so they'd have cash to spend. But the other thing that happened was something called quantitative easing, where normally Joe and all the loan officers like him are originating all these loans every week. They get packaged into groups called mortgage bonds. They're sliced into pieces called tranches, depending on the risk profile, and they're sold off as mortgage securities to investors all over the planet who want to buy those things. Normally, the Federal Reserve or the Treasury isn't involved in buying those. It's, mutual funds in Japan that are buying these things. To really push more liquidity into the market, what the government did is they started buying mortgage-backed securities. So that's quantitative easing. It's a fancy word for we're just going to buy a lot of our own bonds. So if you've got a lot more buyers and you've got a fixed amount of supply, the price could go down a little bit. You didn't have to offer as much to get your bonds to sell. Is that basically what happened, Joe?
You're spot on. And now the reverse is happening. The government's not injecting a lot of money. They're quantitatively tightening, which leads to higher interest rates. And we're getting back to, I would say, a normal market where interest rates are being moved not so much by the invisible hand of the government, but by regular bondholders like Bank of America, Wells Fargo, Chase. They want a little bit more profit and a little bit more premium than the government when they're buying mortgage-backed securities, thus slightly higher interest rates.
Yeah. So the government's sitting on $2 or $3 trillion worth of mortgage-backed securities. I can't remember the exact number. It's some absolutely colossal number. So they're not buying them anymore. They're selling them at a slow rate. So every month that when we have this month's mortgages that need to be sold to the market, we'll also need to get rid of some that the government is selling off. And I think that might also be part of why the risk premium is a little bit high, is that the market clearing price is high because there's so much inventory that's got to be absorbed. I've got to throw more interest rate at it to get people to be incented to want to buy it all.
That's exactly right.
That will eventually burn off, but that's probably part of the risk premium being so high. So if that doesn't make sense, you can call Joe or I afterwards. We'll go through it in more detail. But there's a lot of logic about why the rates are behaving the way they are, but it takes a lot of work to figure out all the steps that influence the rates. Joe, you probably see a lot of this. Can you talk a little bit about this trend of buying with cash? I mean, we've gone from 20% of purchases with cash to 35%. It's almost doubled in the space of 4 years.
Yeah. Traditionally, a third of homes are almost always paid for with cash. That has gone down, as you see on this sawtooth chart here. It's gone down right up until the COVID pandemic, when interest rates suddenly hit 2%. Anybody that had $500, $700, $800, $1 million said, why would I pay cash when I can take out a mortgage at 2 or 3%, invest that difference somewhere else? Well, then this tracks right along with the increase in interest rates. Because if I've got $500,000 in cash and I can buy a property with an 8% rate, maybe I just want to pay cash because I can't find a lot of investments that are going to pay me greater than 8%, unless, of course, I'm an Ironton capital client. But so many people have started paying for properties all cash because of high interest rates.
Yep. So that trend, I think, we're probably at the peak of it, I'm guessing, and that as rates drop,
I think so.
we'll see cash buyers decline a little bit, and that'll result in a little bit more mortgage volume, which is probably good.
Mm-hmm.
Oddly enough, to add to that, we're seeing that a little bit on the multifamily side too. I was just having a conversation with an operator last week, and they're actually looking to acquire properties all cash to provide consistent, predictable income to their investors, which is what a lot of investors are looking for right now, is that consistent, predictable income. And so I hadn't heard that much on the commercial side or on the multifamily side. So it's interesting to see some investors even thinking that if they could raise cash and buy, 5+ unit properties all cash as well, rather than just your typical single family home. It's really interesting to see that approach being taken to the next level on the multifamily side. So, I don't know how often it's happening, but it sounds like some operators are looking at doing that. It's obviously harder to do that on a $50 million property, but if you can do that on a $2-3 million property, you might have some opportunity there.
Yeah, absolutely.
Mm-hmm.
It'd be interesting to see, if you can be all cash, there's going to be a lot more attractive to the seller about the certainty at the close and the speed of the close. So they can probably negotiate much better than they'd be able to in the typical situation. So do the increasing rates have an impact on the market? And the answer is yes. The number of deals being closed is down. That's not new information to anybody on here. The pending sales index is a little bit on the low side, which means for the next several months, we're going to see a little bit less closing activity than historical. Joe, can you talk a little bit about the purchase index and the lock index and what that's telling me about the future?
Yeah, the purchase index is that busy chart on the left. And what we're looking at is that dark blue line at the bottom. And we're seeing lower purchase money applications than at any time in the last 10 years. And I think anybody that's involved in real estate is feeling that right now. There's just less activity out there. And then the trailing number is after you apply for a loan, you get pre-approved, you go out and you look at properties, you get under contract and you lock in your interest rate. And that's the chart on the right, that black line at the bottom. There is lower purchase interest rate locks right now than at any point in the last 6 years. And again, that's exactly what we're experiencing. So the chart on the left is a leading indicator for what's going to happen with activity. And I think we're going to continue to see relatively slow activity as compared to historical standards. But I do think that's going to improve, again, like Lon said, after the election, after we get into the new year, and as interest rates continue to come down. So like Lon mentioned real early on, we've got 3 hurdles to get over, and then we're going to see that blue line on the left start trending back upwards in the future.
Yeah, so it's all going to get better. Like I said, we're probably in the 7th inning, but we've just got some hurdles we got to get through, and all the leading indicators suggest that it's going to be a little slow. Showing activity. So you can see the heavy blue line at the bottom is the 2024 showings per active listing per month. And it's actually not that much different than the 2017 to 2019 average, which is the heavy green line, but it's certainly a lot less than the frothy years of 22 and 21. So if you're a listing agent, the message to your client, the seller, is that every showing counts. A lot of showings come at inconvenient times. And always you've got like a little kid that creates a huge disaster, and then suddenly someone calls, I want to show your house. In 15 minutes is we're in the neighborhood, and that's just a royal pain for your client. But to the extent you can coach them to accommodate, it's going to give you an advantage in a market where there's just not that many showings. People are staying in their homes a lot longer than they used to. This is also part of the reason why we're not seeing as much turnover, the number of unit count, as we would historically expect to see. The good news is that if you ask people, do you plan to move in the next 12 months? The recent uptick in the last 4 or 5 months is yes. It's nice to see that number finally starting to move in the other direction, because that's good for us on the resale market.
So real estate agents, stay close to your database. Go back one slide, please,
Yeah.
Lon. What is it? 18%, nearing 20% of people think they're going to move in the next 12 months. The only challenge, you don't know which 20%. How do you find out? Call 100% of your database.
Talk to them all.
Yep.
There's a lot of people out there. So you might ask, what's holding you back from moving? Well, we're locked in at this 3% rate. So if it weren't for that, when would you be moving? And if there's something interesting that's going on that would normally drive a family to move, sooner or later they might get frustrated enough by that something that it doesn't matter what the interest rate spread is, they're just going to do it. Particularly if they're one of these families like the one that Joe mentioned 20 minutes ago that run up a lot of credit card debt and they've got to do a refinance anyway. Well, if you're going to erase this great 3% mortgage and replace it with one at 6.5%, you may as well move while you're at it anyway, get the house that you want, right? So eventually you're going to see an uptick in the number of deals just because of that. And I think probably, Joe, you're at the first wave of that right now, right?
Yeah. I mean, again, I spoke to that client that I mentioned earlier today. We are seeing it. We are seeing people that have accrued a lot of debt and now need to get rid of it. And they can do a HELOC, they can refinance, they can sell, or they can declare bankruptcy. We've gone through a lot of HELOCs over the last 18 months. Now we're starting to see refinances, and selling will come after that.
Yep. It's just a predictable progression. It kind of goes the same way every single time.
Yep.
Well, that's it for new slides. The long-term, short-term rentals is the same bid as we've had for the last couple times that we've done this. So let's try to do some questions, guys. I want you to think some really hard interest rate questions for Joe and easy questions for me.
Joe already gave us the crystal ball, so we might not have any questions for the interest rates.
Yeah.
Right. And I normally don't. You guys have been getting me out of my non-predictability mode. I normally try and avoid those, but I feel pretty confident, right now. A lot of times the answer to those questions is, I don't know, we'll see. But I feel pretty confident in the direction we're going right now.
Yeah, I actually feel like I've got a better 6-month look forward now than I have probably anytime in the last 3 years.
Yeah, I agree.
Which is refreshing.
Yeah.
Because there's been a lot of mixed signals here where it's been kind of tough to like really give a lot of good insight.
Yep, I agree. Quiet group tonight.
You guys are a quiet group. Well, the last thing I want to do is be like the guy standing between you and happy hour. So I will let you guys go. Thank you for tuning in. And here we go. Kathleen's got a question.
There we go.
It's probably too early to predict, but do you have any thoughts about how NAR settlement will impact the market? I have a lot of thoughts about that. So at least in the Colorado market, and this is probably, I'm going to guess, generally true across most of the U.S., about half the people with a real estate license in a typical year close 0 deals. Another 25% of the agents do 1, 2, or 3. So if you close 4 deals or more, you are in the top quartile of performance. So historically speaking, when you analyze these people who are non-performers, maybe they sell a house every 3rd year, or the people who consistently do like 2 or 1 or 3 deals, they tend to be very buyer heavy, or maybe they're just listing their own house or their relative's house. They don't tend to get clients outside of that. So what does that mean? These people don't have any negotiation skills. They've been really just reliant on the fact that, at least in Denver, there's been a very typical amount that's been paid to buyer agents the whole 20 odd years I've been in the business, and that's now going to be uncertain. What'll happen is, if you're an experienced agent that does 8 or 10 deals a year or more, you're used to going on listing presentations for people that are not your family, where you actually have to explain your value and you have to earn what you're getting paid. And you're used to explaining all that, getting some objections and handling the objections and setting your rate at whatever it's going to be at. Those skills that you have are the exact same skills you're going to use with buyers going forward, explaining why, as a buyer's agent, you should be paid a commission. And here's all the work you're going to do and why it's important to your client. If you can do a listing, you can do a buyer presentation. It's the exact same script with just a couple of very changes. So what's going to happen is a large percentage of the bottom 75% of the agents is going to leave the market. It wouldn't surprise me if a quarter of the people with a license quit in the next 2 years. It could be even a little bit higher than that. And then what's going to happen is that the people who are at the top quarter of people who know how to negotiate and explain their value, they're going to take all the market share of the people who leave. I think the overall commissions on the listing side are not going to change materially because that's been subject to negotiation for as long as I've been in the business. The buyer side is where it's been locked up, and that's the antitrust thing that caused this whole collection of changes. I do think you're going to see a very modest decline on the buyer agency commissions, but not as great as people think that it's going to be. All of the surveys of consumers about their intent, what do you want from your agent, what help do you need in a transaction, suggests to me that very, very little is going to change about the market. So the entire amount of commission income is going to decline a little bit on the buyer side. It's going to be unchanged on the seller side, but the number of people sharing that pie is going to shrink quite a lot. So the people who survive this are going to make more money. And what's nice is that, generally speaking, I would say, for those of you guys that don't know, I started a brokerage called Your Castle Real Estate. I grew it to 750 agents. I've been running this for 20 years. So I've supervised, 80,000, 90,000 transactions over my career. The less professional agents tend to be the agents who are either newer or don't do very many transactions. And it's not because they're bad people. They just don't know what they're doing because they haven't gotten a critical mass of transactions under their belt. So those will be the agents by and large who leave. So the average level of professionalism in the industry is going to increase. So not only will the survivors make more money, they're probably going to have greater job satisfaction because, generally speaking, they're going to be a lot more likely to be working with somebody competent who sets good expectations with their clients, knows how to write a good contract, and it's just really great to work with a partner on the other side of the deal who's like fluid in their job. So I'm optimistic. I actually think this is like one of the better things that's happened to our industry, and I think the people who have the right outlook are really just going to crush it.
I think so too.
So will we see those buy side commissions? Will we see those be passed on often to the buyer, or I can't imagine the seller will absorb the commission of the buyer's agent anymore? Is that correct? Joe,
don't you think they're going to find a way to push that into the mortgage?
Pushing it into the mortgage, no, with the exception of doing a smaller down payment. I suspect it's going to just change the calculus of the transaction. That listing sellers are going to say, hey, we're not offering a commission. And then you're just going to write it into the contract. and say, hey, the list price was 500. We're offering you 515 with a 3% buyer co-op. I think that's what you're going to see happening a lot more. So I think the seller is still going to pay it. Well, maybe the buyer is going to pay it in the form of a higher price, which they're essentially just financing. I don't think you're going to see a lot of buyers paying it out of pocket. But getting it pushed into the mortgage in the form of like a 100% loan or a 103% loan, no, I don't think that's going to happen, because that impacts the risk on the loan. And Fannie, Freddie, FHA, VA, and USDA have been really open that financing commissions increases the risk on loans, and that would potentially increase default rates. And that's not something they're open to doing.
Which is fine. They've been financing questions for as long as you and I have been in the business, but now they're just being, put into a different category on the closing statement. But
we got a question from Kurt. Great question.
I don't disagree, Lon.
Don't confuse me. I'm with the government.
Yeah.
Are you guys seeing homeowners having any difficulty making their monthly home mortgage payment because of the increase in their property taxes and or the increase in their home insurance payment?
No, I'm not, but I do think a function of that might be increased credit card debt. What I mean by that is, let's say my escrow payment goes up by $150 a month. Most people are not going to adjust their lifestyle down and eat out less, go to Starbucks less, cook at home more, or, cut out going to the movies or something like that. What do? Put it on my credit card. So I think the answer to the question directly, no, I have not seen any delinquencies in the form of higher taxes or insurance, but we are seeing growth of consumer credit card debt. And I think it is a trickle down effect.
Yep.
So the other driver for that is, recall about 40% of Americans own their home outright with no debt. So while it's an irritation for them for the insurance and the taxes to go up, because they still have to pay that, they're not going to be as cash constrained as a first-time buyer who's got, from a debt to income standpoint, a pretty heavy load.
Yep.
So good question, though, Kurt. Thanks for asking that.
That is a good one.
Kathleen, your question was great too. I appreciate you asking about that. I didn't mean to get on a soapbox there, but too late. All right. Well, thanks, guys, for making the time, and we will see you guys next month. Have a good day.
See you, everybody.
Thanks, guys. We'll see you soon.